A key bar reversal develops after a prolonged rally or reaction and indicates very strong characteristics of exhaustion by the dominating party. By the time the price experiences a really strong key reversal bar, the trend should have accelerated, even occasionally taking on parabolic tendencies. That means that a trend reversal signaled by a key bar reversal usually packs more punch than a regular 1 and 2 bar reversal formation. The problem is that key reversals are not that common. The classic pattern has the following characteristics. 1. The price opens strongly in the direction of the prevailing trend. Ideally, the open will show up as a gap on a chart. This is what the bar starts off looking like at an opening bar representing a gap. Remember, a good key reversal bar is preceded by a strong and persistent trend. This is a bullish trend for a top, and a bearish one would precede a bottom. The trading range is very wide relative to the preceding bars. So here's the wide trading range, far more than the previous bars leading up to the key reversal. The price closes near or below the previous close, or near or above the previous close in a downtrend reversal. Now I'll put in the closing price, and you can see that there is no real net gain despite all the excitement. Volume, if available, should be climactic. That's an important element because key reversals should come at the end of a persistent move and end with a total exhaustion of buyers at tops and sellers at bottoms. Gaps when they appear on charts are usually filled, or at least an attempt is made to close them, as investors and traders have second thoughts as they go back and revisit their emotions. Since key reversal bars are not dissimilar to gaps, in the sense that bearish ones can experience a sharp drop from the opening to the high, it's not unusual to see a retracement move take place. The retracement will typically fail to take out the high of the key reversal bar, and the move is usually on far less volume. If it materializes, though, it does give participants another chance to go short at reasonable levels. In this case, if you'd gone short and were able to do it with a relatively low risk, the stop would have been placed just above the emotional point on the chart, which is the high of the key reversal. This diagram represents a key reversal at a market bottom, a gap down opening, a very wide trading range, and a close that's close to the high, and it should be near to the close of the previous bar. Volume should also be pretty heavy, thereby indicating seller exhaustion through a selling climax. Finally, we might expect to see a retracement. From a psychological aspect, the weak opening emphasizes the urgency with which the predominating party regards the situation, as sellers are at the height of panic. The gap opening is often associated with unexpectedly bad news. But the way a market deals with pro-trend developments can be crucial in assessing the short-term technical picture. For example, if a company announces earnings that are well below expectations, this could cause the stock price to gap down at the opening. However, if, at the end of the day, the price returns to a level that's just near or just below the previous close, the news has obviously had no new net effect on the price. Since the key reversal bar is preceded by a strong downtrend, this is really the last gasp by the sellers, as strong, informed traders and investors react to the terrible news. It's also the give-up phase for weak longs, many of whom panic out of the security in the frantic activity associated with the early phase of the bar's formation. After all, if bad news can't push prices lower, what will? If it's a stock, we may find out that large institutions are looking ahead at a better outlook, but have put off their purchases until the bad news, which they expected, is out of the way. When the price is sunk to such a bargain basement low, it's an easy decision to accumulate. The wide bar aspect of the key bar reversal is important because it implies volatility, and volatility is often associated with market turning points. When prices open strongly in the direction of the prevailing trend, experience a wide trading range, and close near to where they started, this means that a lot of people are locked in with losing positions, in this case short positions. The higher the volume, the greater the number of people who are locked in. It also indicates that sellers in an uptrend tried to push the price lower and were only able to do so temporarily. They gave it their best and failed because at the end of the bar, prices were little changed from the previous close. These psychological rationalizations would work in reverse, of course, for a bearish key reversal bar. The left-hand part of this chart shows a classic example for Barrick Gold. Note how the short-term rally is climaxed by an explosion of volume and a wide key reversal bar. The opening price is very near the high. Quite often, a key reversal is followed by a sharp change in trend and a subsequent retracement. And that's exactly what happened in this case, as the price rallied in the fourth and fifth session following the key reversal. The termination of this brief advance was signaled by an outside day. These 1 and 2 bar patterns only have short-term significance as a general rule, but often they can prove to be the first domino in a major trend reversal. It all depends on the maturity of the trend in question, combined with the position of the longer-term indicators. In this case, the key reversal marked the top for at least 6 months. The second example of a key reversal to the right is also a good one, in that volume expands along with a fairly wide bar. However, it's not preceded by much of a rally. Thus the bullish expectations were nowhere near as strong as the late September reversal day. This pattern would certainly not warrant as many stars as the first one. Here's an example using Qualcomm at the height of the tech bubble. Note the strong pervasive rally that precedes it. This bar opens with a gap to the upside, but by the close of the session it's fallen back into the range of the 2 previous days. Volume is heavy, but not as explosive as the previous example. That goes to show that it's quite difficult to find textbook examples. Finally, I'll uncover the rest of the action, and you can see that it really was quite something. And that, I believe, was the all-time high for the stock. Key reversals quick review. Price characteristics. A wide bar following a strong and persistent trend. In the case of a top, it gaps higher at the opening, may move high during the remainder of the bar, but closes near to the previous close. At bottoms, it gaps lower at the opening, may move lower during the remainder of the bar, but closes near the previous close. Volume characteristics. A heavy volume day that often climaxes a previous trend of rapidly rising volume. Failure is signaled when the price moves below the extreme point of the bar. Measuring implications. None. Key reversals often develop at the end of intermediate and primary trends.